Hey everybody. So in this video, we're going to be discussing the FIFO method of inventory. We're going to define what it is, give you a couple examples of how it's used in practice. We're then going to calculate the ending inventory under the FIFO method. We're going to calculate the ending inventory under the FIFO lower of cost or market method. And then we're going to journalize the write down of our inventory account. So let's give you a little bit of background on what FIFO is. So FIFO stands for first in, first out. So what this means is that the first or your oldest items in inventory that you purchased are to be sold first. So what that means is if you went in and you purchased some inventory on the 1st of the month, the 15th of the month, and the end of the month, you start selling from the 1st of the month first and then move on to the items you purchased at the middle of the month and then the items that you purchased at the end of the month. So your latest goods that you purchased in inventory are your last to be sold. So by using this method, the value of the inventory on your balance sheet most closely reflects the current cost of acquiring or producing the inventory. So what I mean is that if you produce some goods to sell, the items might be more expensive to produce now than they were, say, 6 months ago. So it's a better representation of current costs on your balance sheet in your inventory account. It's also the most widely used and most widely accepted by accountants and businesses. Some businesses that will use this method sell perishable items that fall in price over time, or items that might become obsolete. So in their mind, it's better to get them off the shelf and get them out of the company and sold into customers' hands as soon as possible. So the downside to FIFO is that it doesn't accurately match your current revenues with your current costs. And what I mean by that is the price that it costs to produce a good or purchase a good is typically more as time goes on. So when you sell a good, you're selling it at today's prices, but the cost of goods sold that's associated with that sell, those costs were actually historical. So they happened in the past. So the prices might actually be a little bit lower than what they are. So there are other methods that more accurately reflect current costs with current sales, like the LIFO method, but we're just going to stick to the FIFO method in this video. So let's take a look at a sample problem. Now, when I do a FIFO calculation, I like to set up these buckets. And the reason being is it helps me keep track of my costs and how many units I have in each bucket. So each bucket represents a different lot that I purchased. So I bought 10 units on February 1st at a price of $100. I bought 15 units on February 10th at a price of $125. So on and so forth. So it just helps me stay organized when I'm trying to calculate this. And there may be better methods out there for you, but this is what sort of helps me keep everything straight. So let's look at question number 1. Calculate the total value of ending inventory after a series of transactions under the FIFO method. So February 2nd, we sold 5 units. So under the FIFO method, first in, first out, we start pulling from our oldest inventory first. So that would be our February 1st bucket. You can see that we have 10 units to start with. So if we started with 10, we sell 5, that means that we now have 5 units left. Next, we have a sale of 15 units on February 11th. So once again, going back to our oldest bucket, we still have 5 units left here. So we can pull 5 units from this bucket. And since we sold 15, we took away 5 already. That means that we now have to take away 10 units from our next oldest bucket, which is our February 10th. So we're going to take away 10 units there. So that leaves us with 5 units in our February 10th bucket. And you notice we haven't even touched our February 23rd or February 28th bucket yet. So then on the 28th of February, we sell another 10 units. So going back to our oldest bucket that actually has some inventory left, our February 1st bucket doesn't have anything left here, so we have to go to our next oldest. So our February 10th bucket still has 5 units. So we're now going to use 5 of these units. And so we sold 10, we used 5, so now we need to pull the remaining 5 units from our next oldest bucket. So now when we go to calculate our ending inventory, we can see that we have 5 units in our February 23rd bucket, and we still have our 15 units in our February 28th bucket. So when we calculate this out, we need to look to see what we paid for these items. So 5 units at our February 23rd purchase, if we look over here at this table, we paid $140 for these. So if we look at that cost, that inventory is valued at $700. Now, if we look at our 15 units that we paid $150 for, that equals $2,225. I'm sorry, $2,250. So if we add those together, that gives us an ending inventory of $2,950. So the answer to number 1 is $2,950. Question number 2. Assume there was a market price drop in inventory to $135. Calculate the amount of inventory under the FIFO lower of cost or market. So what we need to do is we need to look to see, is the cost that we paid for these items less than the current market cost of $135? Well, we have 5 units left at $140, and then we have 15 units left at $150. Well, this $135 is less than both of those numbers, so we need to go in and revalue our inventory account. So how many units do we have left? We have 5 plus 15, so that we have 20 units. So for question number 2, we now have 20 units at $135 a unit. So that gives us ending inventory of $2,700. So our inventory amount under the FIFO lower of cost or market method is $2,700. So step number 3, record the journal entry to be made to write down the inventory from question 2 above. So now what we need to do is we need to get the inventory on our balance sheet at the right amount. So we have it at $2,950. It needs to be at $2,700. So we need to write down this inventory by $250. So in order to do that, we first need to debit an expense account. And this has many different names. I like to use the inventory write down account. So we're going to be debiting our inventory write down for this $250. So this is a expense account. So this goes on our profit and loss statement. And now we actually have to write down our actual inventory account by that same amount. So since we're decreasing an asset, we need to credit our inventory account for $250. Now, some people like to use a contra asset account when they're writing down their inventory. Either way, it just depends on what looks better for you and what the company likes to use. So if we wanted to use a contra account, we would say we would hit like an obsolete inventory account. Conversely, the inventory write-down account, some companies, if the amount is small enough, they'll just hit the cost of goods sold account instead of an inventory write-down account. But some companies like to see this inventory write-down account broken out separately from everything else. So that's the quick version of the FIFO inventory method. If you have any questions, don't hesitate in reaching out to me. Thanks for watching.